Hello everyone and welcome to today's webinar. My name is Pavle Sabic and I work in the Americas Market Development team at S&P Capital IQ. I'm responsible for thought leadership, execution and planning for all of the different areas of S&P Capital IQ, and it's my pleasure to moderate today's event. Now, while you were waiting, you probably noticed that the poll question regarding economic outlook for Brazil was up there for you guys to give your opinion. Well, we'll share these results a bit later on in the session and discuss the results with our panel. Today's topic is navigating the path ahead for Brazil. We have a great program for you featuring a discussion amongst our panelists who will take a look at the country through credit, macro, and market lenses. Before we begin, allow me to provide a brief introduction to S&P Capital IQ for those of you who are unfamiliar with the brand. The brand brings together S&P with its long history and experience in the financial markets and Capital IQ, which is known for its accurate financial information and powerful analytic tools. Please note that the activities of S&P Capital IQ are independent and completely separate from Standard & Poor's rating services. So again, S&P Capital IQ is separate from S&P Ratings. With us today, we have Sebastian Brioso from Standard & Poor's Rating Services and Bernardo Vuisky from Medley Global Advisors. Sebastian is a director in the Sovereign Ratings Group at Standard & Poor's Rating Services and is based in Buenos Aires. Sebastian monitors credit ratings on sovereigns, regional, and local governments in Latin America, and he is the primary analyst for Brazil and Argentina. Bernardo is a senior analyst for Latin America at Medley Global Advisors, which is a leading global provider of macro policy intelligence. Bernardo is responsible for economic scenarios and forecasts for Brazil and other Latin American economies, with a primary research focus on monetary, fiscal, and exchange rate policies. The format of this session will be Sebastian providing a brief update on the sovereign credit state and outlook for Brazil, including a relative assessment of Latin America. Bernardo will then focus in some macroeconomic and policy issues that continue to impact the country. And then I will offer some complementary market trends and analysis before kicking off an interactive session with the speakers. And before we get kicked off, let's just go through a few logistics about the platform on 24 before we get started so everybody knows how to navigate their way around while listening. So currently on your screen you will see widgets for a media player, the presentation slides, and the Q&A box. Along the bottom of your screen you'll see some icons you may not be familiar with. These are the various widgets for speaker bios, the media player, Q&A, slide, survey, and help. We want this to be an interactive session, so please use some of these widgets to get a better understanding and poll some of your questions. And feel free to submit questions throughout the whole presentation, and we'll answer these at the end as time permits. And now, allow me to hand the webinar over to Sebastian Brioso to get us started. Sebastian, what is happening in Brazil from a sovereign credit perspective?
Okay, thank you, Pablo. Good morning, everyone. If we could move to the slide with the agenda, please. Basically, the idea here, we based this short presentation in three main areas, and briefly discussing Brazil rating history just to show that up front. Then, secondly, talk a bit on Latin America and Brazil, on the key structural challenges ahead. And thirdly, and of course, important within this conjuncture is how we assess the fiscal picture in Brazil and to what extent that could have implications into the rating. But just to get to the end quickly, I will anticipate the conclusion. The conclusion is that Brazil has become macroeconomically more stable, and this is a great advance compared to where we look at Brazil in the 80s or 90s, and Brazil is rated 2 notches within investment grade, and this is an important piece of information. However, this greater stability has not translated itself into a dynamic economy, and really growth has been on the pending side and continues to be on the pending side. And thirdly, within this conclusion is the fact that this lack of growth is starting to put these macroeconomic achievements at risk, and this is what we'll be focusing more extensively throughout this through the presentation. All right, going to the rating history, you have the, just to put this up front very clearly, Brazil moved into investment grade back in April 2008. That was very important achievement. And then in November 2011, upgraded to BBB. And this is a very important issue as well, because it gave, some way of reading this is that Brazil has some space from the rating perspective. It does have some space for deterioration while staying within the investment grade rating. And this is a category, and this is a very important thing. As you all know, we revised the outlook to negative back in June 2013, and the main issue that the negative outlook represents is a signal that we are worried about the government response to this low growth performance, because we believe that there is no enough room for fiscal countercyclical policy in Brazil. Another way of saying this is looking at the time we upgraded Brazil to investment grade in 2008, is the saying that Brazil was upgraded to investment grade despite the fact that the fiscal situation was still rigid, and there's still some weaknesses on that side. Moving to the first chart, where you see real GDP per capita, and then going a little bit backwards to what we have seen in Brazil and in the region. I think when I refer to the fact that Brazil has become more stable but less dynamic, or with the really pending with growth on the pending list, that's almost the same reality for Latin America. Latin America's GDP growth actually has been on average of 3.8 between 2012 and 2002, despite the fact that the region has enjoyed probably the most extraordinarily favorable commodity prices in history, right? So with all this extraordinary positive external shock, the region has grown only at an average of 3.8. And going forward, with China growing less, in particular, we are forecasting a growth rate of only 3.2 for between 2013 and 2015. So that's really showing the fact that the region is less vulnerable to volatility in global markets. Most of the region has now floating exchange rates, fiscal responsibility laws, monetary systems with inflation targeting, and this is a great achievement. The level of external debt has come down significantly, but the region is not growing enough. And one caveat of this, which is very important, is that those rates of 3.8 or 3.2 for the future are basically weighted average that bear into consideration the size of the economies of the region. So part of the problem there is that the two largest economies in the region, Brazil and Mexico, which together represent 62% of the GDP of the region, are the ones growing poorly, as you can see in the chart in front of you. So really, poor growth in Brazil is a major issue, but it's also the same issue in Mexico. And it's actually, you can see how these economies are growing less than, of course, India, which is coming from a much lower GDP per capita, but also Russia and some others. The idea on this chart is to present some of the BRICS, such as India, Russia, or even South Africa, and then key regional peers such as Colombia and Mexico. So it's really growth has been on the pending list, and as you could say, as I was referring to, when you look to the average 2008-2012, or the estimate for 2013, or the future, growth is not expected to recover in Brazil. And if we move to the next slide on the gross domestic investment to GDP, there lies the main shortcoming, the major disappointment when looking at Brazil over the last 10 years or so. Really, that despite these improvements on macroeconomic fundamentals, these lower levels of external or fiscal vulnerability, really investment has not really increased significantly, and we are looking at investment levels in Brazil that are still below 20% of GDP. And that compares really poorly to all these countries I chose to incorporate to the analysis here. You see well below South Africa, Russia, Colombia, Mexico, and of course India. And this one of the issues behind this data is it goes back to the fiscal picture in Brazil and why fiscal remains so important for us as a rating agency, because really is not only that private investment is not growing enough in Brazil, but it is the fact that public investment remains among the lowest levels of investments in terms of GDP within the emerging market world. I mean, Brazil invests on public from the public sector basically roughly 1.8 of GDP, which is extremely low when you bear in mind that Brazil has a large public sector that represents about 38% of the GDP in Brazil. So in order for this to move ahead, there's a strategy is needed that boosts both private sector and public sector. In the private sector, I think there were ambiguous signals from the government, and this has triggered some business confidence problems, and that's why we are not seeing investment from the private sector improving. And really from the public sector, I mean, the big question there is whether it is possible or not for Brazil to really move ahead and increase public sector investment without structural reforms, because really at the end of the day, this government expenditure structure is extremely rigid, with a lot of weight assigned to pensions and many other expenditures that are actually embedded in the Constitution. And really, of course, if we go to the next slide, my last chart, and you see general government debt to GDP, and it's just exactly what I was referring to just a minute ago, by saying you see that government debt level is close to 60% of GDP, expected to be close or slightly above even going forward, about 60% of GDP. And this it reflects the fiscal rigidities we see in Brazil. And why, I mean, when we go back to my first statement, my conclusion is why we believe that Brazil doesn't have space for countercyclical fiscal policy. And so if the government's reaction to this low growth paradigm or environment is to boost the GDP growth by increasing expenditure, by reducing the primary deficit further, or by continuing stimulating domestic credit by lending to their government and all banks, which has a direct implication on the government's debt level or the fiscal outcome, we believe that Brazil's rating might not be consistent with the BBB rating anymore. So those are the issues we are looking at this moment. I mean, of course, a big question in the marketplace is how elections play in terms of affecting our potential action on the rating. And basically, I mean, the way we answer this and the way it works for Brazil or from all the other countries we rate is that we respond to events. I mean, and the events we are looking at Brazil right now is the combination of the fiscal performance and on the one hand, and on the other hand, the government strategy towards fiscal policy over the medium term. The combination of both will be the ones that will be determined whether the rating remains as it is at the BBB level or comes down to the BBB minus level. And with that, I finish this part. I turn it over to Pablo. Thank you.
Thank you very much, Sebastian. That's very, very interesting, like kind of hovering between the pessimistic and the optimistic. It was interesting that you said, 62% of the total GDP for the region is Mexico and Brazil. So obviously people are looking towards these countries for the growth, and you said the growth is not really coming from there. Also, you mentioned that this BBB status for Brazil is questionable. Now, so the question I wanted to ask you is, in terms of 2014 outlook for Brazil, is there a particular indicator which reaching a certain level that would trigger a downgrade or an upgrade for Brazil?
Thank you, Pablo. Well, I mean, there's one important indicator. I think there are two important indicators. One is the primary surplus, as reflecting the government effort to curb this fiscal slippage we've been seeing, and the one related to that is really the general government's debt. But having said that, we don't have a threshold that in it by itself could trigger a downgrade. But of course, I mean, we believe that the Brazil needs a primary surplus close to 1.8% of GDP. This is a general government for the debt level to remain stable over time. This around 1.8 again is not a threshold. and pretty clear Brazil this year and next might be reaching a primary surplus that is lower than that. But really a distant number from that level will mean that that sustainability will enter into a different scenario, whereas debt level will increase more rapidly, and it will require in the future much larger primary surplus, and therefore restricting fiscal flexibility even further. And that's why we believe that scenario is not consistent anymore with BBB. But again, as I said, it depends on the levels of primary surplus we continue to see, and the government, and how the government strategy on the fiscal side is set going forward.
Okay. That's interesting. In terms of, so you mentioned some of the BRICS there. We actually do a paper called Credit Market Pulse that we put out recently, talking about the average PD trends for the BRICS against the rest of the regions in the world. Focusing on the BRICS, obviously with Brazil in there, what's your kind of thoughts about that BRICS region and how they're going to go forward, and the kind of implications that China has on the Brazilian development, just very briefly?
Sure. I think that, in terms of the relation more specifically in between China and Brazil, I think that Brazil is not one of, and I refer to the BRICS later on, but Brazil is not one of these countries whose growth path or growth performance is extremely dependent on external demand, right? That's one of the problems we are seeing in Brazil today, is that this growth dependence of domestic demand, and was primarily based on consumption, and this is facing a phase of exhaustion. Really, there's no really space for Brazil to grow further on domestic consumption without improving investment. But really, the exports to GDP in Brazil remain close to 12%. We could say that Brazil is still a relatively closed economy. But the problem is, although not dependent on China, in a situation where the domestic sources of growth are facing a period of exhaustion, it's really the fact that the external demand is no longer there, or not as strong as it used to be. It doesn't help, and makes the whole environment more complicated. But again, compared to the BRICS, really, I believe, there are not too many similarities. I think that the big similarity is, of course, the size, the population, and the impact on the world economy. But you have highly growing economies such as India and China, who's growing basically based on a very large level of investment, and lacking what Brazil had, which was a large consumption base. And on the other hand, you have Brazil, which it lacks investment, but it has a strong consumption base. So I think that going forward, the best scenario we could see it is one of a more balanced growth in both places, right? With investment growing more rapidly in Brazil, and consumption growing more rapidly in China, although we have to wait and see.
Okay. No, that makes perfect sense. Fantastic. Thank you very much, Sebastian. Let's do this. Before we turn it over to our next speaker, why don't we take this optimism, pessimism kind of thing, and turn it to the audience and see what their take is on this. So earlier on, while they were waiting to start the webinar, the question was posed, what is your outlook for the economic state of Brazil in 2014? And the choices for my fluent Portuguese was tudo bom, igual, and tudo mal. Now, what we wanted to find out was really, when we're talking about the optimism and pessimism, particularly what Sebastian just said, and also leading quite nicely onto Bernardo's, is what exactly is the sentiment of Brazil moving forward, generally speaking. Now, Bernardo's going to look at some of these policies. There again is a few kind of troubles that we have in Brazil. I'm going to look at the M&A side later on, which actually there's some interesting and positive signs that are coming up there, which is tied in from this kind of macro policy and overarching look at Brazil onto a more market sentiment. So I think all the polls are in, and let's see what the audience thought. Right. Okay, so there's a few people that are hovering on the fence with igual, tudo bom, and actually there is more kind of pessimism in the tudo mal than the positive. But we still have nearly 56% of the attendees thinking it's a GWAL. Okay, so maybe that sentiment is going to change going forward, and going forward we want to hear Bernardo weighing in on some of these topics. So Bernardo, if you would be kind enough to let us know a little bit more about the relationship between Brazil's economy and the fiscal policy. How is that shaping up?
Sure. Thank you, Pavle. Good morning, everyone. I have basically two messages to tell today, which are obviously directly linked to what Sebastian was saying, and that at the end of the day, for me, suggests that I'm actually on one in the negative side of the recent pool, basically because I think that the combination between the growth story that Sebastian was talking about, and I'm going to talk a little bit more about it, and the political side don't suggest that we could see a reversal of policies towards protecting or sustaining the investment rating right now. I'm not obviously saying Brazil is going to be downgraded. That's Sebastian's side, but I'm just saying it doesn't look that any reversal is going to come anytime soon. And the first reason for that is that there are clear signals that the Brazilian government has been insisting, and at this point we can say much more than it should, on a consumption-led growth model, which is clearly showing decreasing returns over time. This model actually started, even before the 2008-2009 crisis. I think it was intensified during the crisis to create a recovery. But then it lasted pretty much as the only solution for the government to do that, which includes a variety of things, but all of them on the stimulus side, all of the fiscal expansion and tax cuts, and one particularly aspect of it, which I think is very important to mention, which is in his first slide, is the size of the public credit expansion over the past couple of years. So if you look back in 2011, actually public credit was more or less the same share of private credit, and since then the government has been expanding tremendously the public sector credit from all of this, to all of its public banks, including the commercial ones and the BNDES, the investment one, trying to keep the pace of growth and forcing these consumers to continue spending and to continue pushing growth, which was what created growth over the past decade. But the reality is that for many reasons, consumers are at their limit. So we can see on the other side that the level of debt from the consumer side is quite high, and people are not really continuing to buy the same amount of goods that they've been doing over the past decade. There are clearly signals that this model is reaching a point of exhaustion, and there's no point in insisting on it. So if we move to the next graph, it shows that in the same period of time, we actually had quite a significant deceleration of growth in Brazil, and which is quite striking due to the level of increase on the public banks, and particularly the credit from their side. And I think that what this is creating at the end of the day is part of the story that Sebastian was speaking earlier, which is fiscal policy is actually paying the price for all of this, because the more you create stimulus and you don't get growth back, you actually create to itself a problem in terms of revenues. So both in terms of this direct fiscal stimulus and particularly the off-balance sheet stimulus, which comes from these public banks' expenses. Basically, the government has been capitalizing these public banks in order for them to provide credit to the market. And what we actually see, which is the third graph, is basically an increase in the gross debt, despite a reduction in the net debt, which was related to reserves over time. You can really see the beginning of an increase of the gross debt, which it's now close to 60% of GDP. And this increase in the gross debt, it's not coming by itself from the bad primary surplus, which is part of the story, but it's coming from these off-balance sheet operations with the government increasing capitalizations to the public banks. The problem here is that, and this is what I think is the main message that I want to send, is how the government's going to deal with this going into an election year next year. And that's where I think things get more complicated, to be honest, because the government is kind of trapped into a very difficult trade-off between stimulating growth and continuing insisting into this model, which we're seeing it's not bringing returns, and on the other hand, controlling all of this and reversing all of this and running the risk of having even weaker growth and having the elections as a problem. We all know that politically the government would like to have a triple combination during the elections, which is a combination between low inflation, high growth, and stable to low unemployment, which is all governments want. But the Brazilian government seems to be quite in a tricky position on this. So if they decide to continue stimulating and enforcing this model to go on, they might even get a little bit more returns in terms of growth, even if decreasing ones. But at the same time, it increases a lot the risk of downgrade. And from what Sebastian was saying, it's clear that's a path that they shouldn't follow. However, on the other hand, if they decide to control all of this and, for example, reduce the capitalizations, reduce public lending, and actually reverse in part the fiscal position, they could control, and that's a strategy that would be welcome from the rating point of view. They're going to run a big risk in terms of the growth disappointing even further. And I actually think that, considering the level of growth we've been having now and the level of stimulus, a reversal from this point would probably take GDP growth in Brazil to even weaker levels, probably close to the 1% or even zero if we're running around the 2% right now. And I actually think that the government doesn't have a solution for this trade-off, which is the story about my final slide. The government doesn't really know how to deal with this. So they are not going to come up with any clear strategy to reverse the fiscal story because they know they're going to find the growth problem. But on the other hand, they at the same time cannot give up on all of the stimulus they've been giving over time because of the elections. And all of this suggests that this sentiment that most in markets have and that triggered S&P to pretty much revise the outlook. It doesn't seem it's going to change anytime soon. The elections are obviously an important point of possible changes for after it, but at least for the next 3 quarters, our expectation is that this trade-off continues hitting the capacity of the government to really find a solution to both sides. And that's why we'll probably continue to be negative on how the rating story is going to look like. So this is basically the message I wanted to send, and I'll pass it back to Pavle now.
Thank you very much, Bernardo. So decreasing returns, fiscal policy paying the price. Brazil is a very expensive country, and then so this kind of high inflation, costs are quite high, this kind of stuff. How does this affect real estate market and everyday person in Brazil? So taking it from the fiscal government side and taking it onto the everyday person in the street.
Right. Yeah. I think that the level of inflation we've been seeing over the past couple of years, with when you look at inflation, quite pressured situation on the service side and on tradables, is actually a direct result from this model, right? Which is a model of pushing the fiscal story and the consumption side of the economy up to the limit without finding real solutions for the supply side. But at the same time that this was kind of the story over time, and it has actually pushed the real estate market to increase prices. I don't think that's the main problem that Brazil is going to face over next year or the next couple of years. because as we're discussing, there are clear decreasing returns from this model right now. And even with the government still pushing this model to the limit, we can see that growth is unresponding, and actually the labor market is starting to show signals that it's not going to be as tight as it has been for the past couple of years. The unemployment rate is still low and in a good way because the labor force has not been growing, but the job creation, wage growth, all of these indicators have been slowing their pace. And I actually think this is actually good for inflation in the medium term. I don't think the inflation is going to be solved because of this. I think there are many other issues, and the currency is one of them. But at least the service price of inflation and the non-tradable part, and which could affect the real estate market, I don't think that's a big issue for the next few years.
Okay. I'm really looking forward to the panel discussion because I can see some good discussions coming up here between yourself and Sebastian. I was looking at how I could tie in possibly the Olympics and the World Cup, because I can't believe we've got this far in the webinar without discussing it. Job creation, you talked about job creation and job growth. What kind of impact is the World Cup going to have, apart from having the rest of the world glued to their screens looking at the wonderful Brazil?
Right. I think that so far, after all of this couple of years with the discussion about the World Cup, it's pretty clear that in terms of that at this point, the World Cup hasn't been able to trigger, the public investment necessary for the infrastructure sector. The government's actually trying to do some of this more recently with the concessions, and we've been having mixed signals about it. But the reality is that most of what's being done for the World Cup is really specific investments to things like the stadiums and so on, and not really providing the infrastructure that would be necessary, which is part of the problem of Brazil's supply side. On the other hand, I think that the World Cup could, in theory, help a little bit the sentiment over next year, depending on how things go. So it could provide some short-term relief for this, relatively negative story in terms of creating some more consumption. The retail sector and the employment could be potentially capitalize on this for a short period of time. But I don't think the World Cup is going to bring or leave some of the important things that Brazil would need for the medium term. It would be really a short-run relief on the story.
Okay. So in the short term, it's a very, very positive stimulus, but medium to long term, it's questionable. Okay.
Exactly.
Thank you. Thanks a lot, Bernardo. Thanks a lot, Sebastian, as well, for your insights. So we've gotten a solid background on the macroeconomics, credit, and fiscal policy and the situation currently unfolding in Brazil. We're obviously going to go back to that in the Q&A, discuss that further. But I'd like to switch gears a little bit and provide more of a market perspective with regards to M&A activity and the sectors in Brazil, in the country. The first slide that I want to look at kind of ties in everything that we've been talking about and brings it to the market level, and it does this by looking at two things. So one, in the solid blue line, is the S&P rating for Brazil since January 2011, run over that period all the way through to kind of presently, really, versus the market-derived signal, which is a credit default swap-based lowercase signal, if you like, for the creditworthiness of the country. What this means is we've got the thorough analysis from the S&P ratings practice, and then we have this market sentiment of Brazil. And there we're seeing an exaggerated optimism back in 2011. So when you see the light blue line being above the dark blue line, so basically that the actual sovereign rating is lower than the optimism that you're seeing from the kind of market-derived signal from the CDS market. And then moving to more presently, we see that there is a pessimism there. So what happens is that this market-derived signal drops below the actual S&P rating. Now, there is some sort of correction in the market going forward right now, and this probably echoes what we heard from our panelists as well. But what I want to do, since this is S&P ratings, I want to bring in Sebastian so he can give us, his 2 cents on this graph here and his thoughts. Sebastian, what do you think of what we see here in front of us?
Thank you, Pablo. Yeah, we always comment on this because it's a very interesting chart. Because one of the questions we ask ourselves, and the market also asks itself, is basically, is what we are seeing in Brazil today something new or new or old? Are those new problems just regular problems a country has or faces as it moves upward in the ladder of economic development, or just the old problems? To some extent, those are the old problems. Brazil has not really grown rapidly since the 60s. The fiscal rigidities we are seeing in Brazil are the same ones that we've seen then. The problems with high domestic interest rates are the same problems we have seen in the past. So basically, of course, many of us believe that by this time we will be seeing investment to GDP level above 20% and not one of barely 19%. But really, I mentioned this because when we go back to 2011 and the market was the drive rating from the CDS at that time was got to a single A plus. I think that also explains the level of pessimism we hear from the market these days in Brazil, right? Because when you compare that to our rating barely moved throughout this period, right? So we do highlight that we see some negative signals in Brazil, and we actually highlighted that with the negative outlook, but we do not believe, and this is important, we do not believe at this point that Brazil is facing risks of losing its investment grade status. What we are saying is that, of course, there are some dynamics that could affect general government debt in the future, and that might not make Brazil consistent with BBB, but we are not saying that the risk of falling into speculative grade is a significant one.
Okay. So of course, this market-derived signal is looking at daily changes in the credit default swap. So it's a good indicator on a very frequent basis as to the kind of sentiment of the market. And Bernardo, what do you make of this graph and also the sentiment of the market? Is this quite correct? Does this echo what's going on in Brazil?
I think it is. I think as Sebastian was saying, I agree with him that the sentiment was over positive back a couple of years ago, and then the sentiment now, but actually the sentiment now looks more in line with even the S&P change in the outlook. I think in a way what's going on here is that markets are anticipating that part of these problems we were talking about are not going to be solved in the short run, and this will ultimately, lead to a rating problem. I also agree with Sebastian in the idea that it doesn't look that the problems are big enough to put Brazil in a non-investment grade situation. That doesn't sound the direction of things. It's really a deterioration of the model and weak growth and, in fiscal policy paying part of the price for that. But still, the graph in a way is showing that because it's pretty much pushing market sentiment towards, a rating downgrade, but not below investment grade.
Yeah, absolutely. I think it's a very critical point, isn't it? That BBB negative is a very significant line. If you're above, it's a huge difference to be below it as well. And I think what I want to lead on is to talk about M&A. And when we're discussing with our clients and a lot of the research that we do, we're finding that a lot of the deal makers within the region in Brazil are basically saying that it's the sluggish economy and the sluggish economic growth that's leading M&A to be not as strong as it was in the past. And something like this also ties in with that M&A kind of going forward. So on the next slide, let's just have a quick look at what's happening in the merger and acquisition markets in Brazil. So the first slide on the left-hand side, it's clear to see 2011 was a big year for M&A activity in Brazil. You see that blue bar there, 107 billion. Now, what happened that year was there was significant telecommunications merger and acquisitions that happened. For example, there was a $31 billion deal, which is absolutely huge. Brazilian Telecom SA agreed to acquire Telenorte Leste. And there was, we're going to look at this on the next slide as well, some of the other deals, but here we see that 2012 is significantly lower, with $27 billion, round about there, but the actual transactions were a lot higher. So there was a lot more mid-market transactions that happened, but none of those really, really big deals. There was really big bets, if you like, on companies within Brazil. So the kind of mean deal size was about 126 million in 2012 against a 459 million in 2011. So there was a significant change there. However, if we look at 2003, 26 billion, that's at the end of November. So it's likely that the end of this year will probably prove the same as 2012. That will be, again, that igual sentiment, perhaps even tout de bon in terms of better than 2012 M&A. So we'll see how the year closes, but that's a fairly positive sign there. In terms of telecommunications, when we look over on the right-hand side, where the telecommunications is quite low because we're looking at the actual activity, the number of transactions. And they were small because all of them were really sizable deals within the telecommunication industry. Where there is a lot of activity, well, that's financials, as you can see there in 2012 and this year as well. Industrials and consumer discretionary, which was rather high. So these are the kind of areas that are looking promising for Brazil in terms of the activity that's going on in this region. And we often get, we've had a few questions coming in as well, and one of the questions is, where do you see the growth for merger and acquisitions in Brazil? Now, it's far from us to look at the future and try and see what's happening, but in terms of the actual figures that we're seeing, it might be consumer discretionary, and the reason for that is if you look at the digital footprint of Brazil, so we have, or the region, we have about 159 million consumers online in terms of a kind of social media and these kind of things. So that's a 21% increase from last year in the region, and 42% of these users are located in Brazil, while only 15% are in Mexico. There is actually a lot more social media users in the region than there is in the United States. So it's a very booming sector. So, for example, Twitter, Netflix, Waze, for example, have scaled operations in that region. So this really points to consumer discretionary that's going on there. So now going over to the next slide and looking at, identifying some of these companies that actually made an impact over the years. We're looking at the two top deals in M&A for Brazil since 2010. And we see at the top there that we have consumer discretionary at the top, around about 2.8 and 2.7 billion there. Then in 2012, we had healthcare and materials as the big transactions. So United Health purchase of Emil Participações. Now that was quite an interesting move because United Health historically were doing merger and acquisitions within the U.S. So this is one of their biggest acquisitions outside of U.S. territory, and of course it was in Brazil. So that was a very positive sign. But if we look at 2011, it's very hard to come to these standards. Again, 31 billion for Telenorte, then 22 billion there for Cori, and the third biggest one was 17 billion. So there were huge acquisitions in 2011, a flurry of acquisitions going on there as well. Like I say, consumer discretionary were the top sectors in terms of the biggest deals this year, and it was a different story going back historically. One of the things that was very kind of optimistic and very positive, I would like to kind of echo some of the positive signs of Brazil as well, is that the foreign direct investment, FDI, in Brazil, according to the World Bank, was third highest globally after China and the United States. So foreign direct investment is coming in, means external investors are investing in Brazil, which is, again, a very positive sign. So generally speaking, yes, M&A in Brazil was down from a sprinter's pace in 2011, but it seems as though some of the environment, including the kind of exchange rate, will be positive for investment there as well. So there is positive signs. There's still positive indicators amongst the kind of lackluster economic growth that we're seeing, and it's not all coming to an end. So with that, I think we've completed the kind of top-down analysis going from the macro all the way down into the sector specific. And now what I would like to do is open up to the audience for questions. Actually, no, what we want to do before then is do a panel discussion. We've had a significant amount of questions prior to us even starting the webinar, and so I want to get Sebastian back in the mix and ask him straight away with this question. Is it possible to downgrade Brazil during election period? Sebastian, what are your thoughts on this?
Of course, the elections are an important event for any of the countries we look at. But I mean, as I said at the beginning, we are looking at the combination of the current fiscal picture and this fiscal strategy going forward. If we get convinced that the government has decided to play this card more extensively in terms of pushing aggregate demand by expanding the role of government-owned banks even further, or government expenditure directly, and we believe that move is not combined with a strategy that curbs that expansion over time, we could take an action on the rating, even before the election if needed. But really will depend at the end on the dynamics. Is a dynamic story, will depend really on events and on the fiscal picture again, and the government strategy going forward.
Okay. All right. With that in mind, in terms of, you just mentioned a few kind of scenarios, I'm going to turn to Bernardo and ask, which are the worst and the best economic scenarios one could expect for Brazil, let's say in the next 2 to 3 years?
Right. I think that the best case story that we could expect is finally some kind of change in the model that would need reforms for that. And this change of model would probably allow this recovery in the growth story without pressuring the fiscal position anymore, which is what everyone is worried about. There are many reforms that would need to be delivered for this to happen. A tax reform is very important, a pension fund reform. There's all the infrastructure issue that needs to be solved, and that's probably the only thing that in a way the government is already taking care of. So I think the best case scenario is one where the government by itself, before or after the elections, it doesn't really matter, moves on with an agenda of reforms, right? I think that the worst case story we could think of is one where this deterioration doesn't end, and the government double bet on the story in a way that really puts the fiscal position and the overall story of the economy at a much higher risk, which we could then be talking about really a losing investment grade, depending on how much the government insists in the same thing and in expanding the fiscal story, the debt, reducing, is still with low and very weak growth, and this could affect the currency and inflation. So there's obviously a negative story that could be triggered by insisting too much on this. I don't think as well that the government is there. As I was saying earlier, I think they're in a trade-off. They know in part the risks of this, but still, that would be a worst case story we could build, I think.
Okay, so then, Sebastian, I want to see what you think about Bernardo's thoughts there, and by asking you this question, what is the key structural reform that is needed in Brazil to make it beat S&P's expectations?
I kind of agree with what Bernardo laid down as a key reforms. I think that almost 100% of the people looking in Brazil agreed on that really what Brazil needs to get is greater flexibility on the fiscal side. I mean, bear in mind, I think this is good to add to the discussion. I mean, that why we have a negative outlook and we didn't downgrade Brazil at this point. I mean, because it's really a dilemma going on between macroeconomic stability and growth. because it's true we focused and I think correctly on the fiscal outcome and the fiscal policy, but I mean this dilemma is going beyond fiscal, right? And so we are seeing a country that has increased the reference domestic interest rate by 275 basis points throughout the year, whereas most of the countries of the world are cutting rates, right? And it's the countries doing that while growth is not there. So I think that the dilemma is going on there right now, and I think that the problem is on the fiscal side. The government has decided to test the limits a bit more because of the underperformance in growth. I think on the reform front, as Bernardo was saying, I think that the critical again is to get flexibility on the expenditure side, on the fiscal side in general, because it's not the problem on the fiscal. When we said that Brazil has fiscal problems, is not only the debt level, which is large. I mean, 60% of GDP is large, but it's even larger when you bear in mind that the utilities we see on the expenditure structure. As I said at the beginning, most of the spending is really operating. Current expenditure is not investment, and this is a critical factor. And then most of the spending, a significant part of the spending are embedded in the Constitution, that's pensions. I mean, we look at Brazil's fiscal performance for this year, and we are talking about a fiscal deficit overall, I mean, including interest payments, of close to 3.3% of GDP. About 2% of GDP is basically the deficit of the pension system in Brazil. So the pension system it's a government's decision which pension system it has, but the problem is if you cannot afford the pension system over time, and this is one of the risks Brazil has. So therefore, answering directly to your questions, and pension reform is critical, tax reform is critical. And the problem is that these issues have been in the agenda for a long time in Brazil. Brazil is an extensive and complex democracy. It's almost a continent as a country, with very different constituencies and regional and politically. So these reforms, which in many times require constitutional amendments that require 2 votes in each of the chambers, but 2/3 of the votes are politically costly. So it's really up to the new leadership, whoever that leader is. I mean, if it's a re-elected government or a new government, where if they decide to pay some political cost to try to create this greater level of flexibility on the fiscal side that would allow Brazil to smooth out the business cycles if needed going forward.
Okay. Okay, so another question that we got in about M&A stuff was asking where, in terms of which sector, we mentioned consumer discretionary, but which sector is looking like it's going to be very active next year in terms of the kind of investments and the infrastructure that's being changed there, and in terms of the region as well. What are the kind of hot areas? Well, energy is quite a big, a lot of reforms happening in energy. A lot of the companies, of course, are based in the kind of, east of the country, where all the headquarters are for majority of the corporations, but it's the kind of northern part of Brazil that are seeing a lot of these exploration, particularly in energy, that are going to give these hot sectors potentially going forward. And that's some of the things that the government is really focusing towards, is this expansion in the energy sector to try and bring these M&A flows and increase these FDIs that we mentioned earlier. One of the other things also that is important to mention, which we did in terms of M&A, was the private equity markets is very, very important. And if we just take a look at one example, in 2013 actually, and that was a $705 million deal for Alphaville by the private equity firm in the U.S., Blackstone. So that was very recent. PE markets are very, very important for Brazil, and that's something that we shouldn't, we should take into consideration as well when we're looking at that. Now, in terms of other kind of investments, what I want to do is bring Bernardo in there, and we have a question that came in asking, what are your expectations for investment in credit in Brazil? So Bernardo, what are your thoughts on the credit markets in Brazil?
Sure. I think that in a way the credit market story is very linked to what we were saying in the presentation about how much the government is still willing to test the limits of the current model, because the good part of the credit story is very related to the public bank's expansion. And actually, what I think about this is that there are many signals from the government that they are concerned, with the credit rating, and that they would like to decelerate the pace of growth of the public credit. I don't think they want to do it in a way, or they're going to try to do it in a way to balance as much as they can this trade-off between growth and rating. But my impression is that the government will try to slow down a little bit this over the next year, because this would reduce the need for capitalization from the Treasury. It would help a lot to not increase the gross debt to GDP. As for the private sector, I think the private sector has been reducing its pace of growth of credit, not only because the government in a way has been crowding out it, but also because it on the other hand of this story, it has also seen this deceleration in growth and rising NPLs. And I don't think that the private sector is going to re-increase or re-accelerate its credit expansion unless it's a reversal of this thing. So the government will need to start first and give some space. We will need to see some recovery in business confidence and in growth for then the private sector to get in. Right. So overall, it's still quite a mixed story, but I would expect some slowing down a little bit further from what we have so far.
Okay. No, that's very interesting. We've had a lot of questions, and they're still kind of coming in. Unfortunately, we're rapidly running out of time. So I picked one question that I think is very good to finish up with, which we can both get a perspective from Bernardo and Sebastian. And it's fairly controversial. And the question is the rating downgrade an exaggeration? ? So Brazil has much more sound fiscal situation than many European countries that have higher ratings. And I think this kind of, this question goes across the spectrum that we've been looking at today, the policy, the economics, the M&A, the positive and negative kind of signs. So let's start off with Sebastian. What do you think of that question? Is the rating downgrade an exaggeration?
Well, by signaling with the negative outlook that there is a chance of a rating downgrade, I mean, we are clearly saying that we believe that's appropriate. And of course, I mean, basically the rating business is just to compare the different countries and then their fundamentals, right? And of course, I mean, when you take one variable, one indicator in by itself in isolation to the others, I mean, they not always give you the right picture. Because, for instance, I was showing India, for instance. India has a higher debt level than Brazil, and somehow it's rated similar to Brazil. It's actually one notch below. I mean, but they could somehow withstand a much higher, significantly higher debt level than Brazil because they grow at 6 to 7%, and that's a major difference, right? And the same thing applies for European countries. I mean, European countries, they might have higher debt levels. I mean, some of the top-rated AA or AAA countries have much higher levels than Brazil, but they have GDPs per capita or GDPs in general that are several times those of Brazil, a more flexible economy, and even despite the fact of having higher debt levels, their fiscal situation is much more flexible. So that's why I was referring to, when I mentioned the fact that Brazil's debt level is high, I was referring to the fact that it is higher compared to some of the other characteristics prevailing in the fiscal picture in Brazil. So that's why we are reflecting with a negative outlook, and then there are some fiscal risks. Again, those risks are not risks that will lead to a fiscal crisis. Otherwise, we wouldn't be speaking about a country still rated in investment grade if we were to downgrade, which is not a fact. But those risks exist.
Okay, so in certain European economies, fiscal policy is better, GDP is higher, flexibility is there as well. Bernardo, what do you make of this?
Well, I think Sebastian is really the one to answer this, and he gave a clear explanation. I would just add that I also don't think it's an exaggeration, and I would just add two things. One is the trends matter. And the direction of things, and they've been clearly moving as we've been showing from to the negative side. So in a comparative world, we need to look at this. And the second thing is the cost of this debt. So it's not only how much debt from GDP we have, but how high interest rates are, how much it's costly to roll all of this, and so on. I mean, the maturity of this debt. There's a lot of other conditions that could make even a 60% of GDP debt much more risky than 100, depending on how costly it is to take care of it. So I think these are just two things to add, which suggest that it's a risk. It doesn't seem to be to me a big exaggeration.
Okay, I think that question has been answered kind of explicitly, and I completely agree with both of your sentiments. With that, let's just ask one small, tiny little question to end off with. Starting with Sebastian, what would you say economic outlook for Brazil? Tudo bom, tudo mal, or igual?
Well, the problem is that tudo bom or tudo mal could mean very different things when you get into the detail, right? I think that as our ratings say, I mean, Brazil is rated 2 notches above investment grade. It's the highest rating the country ever had, but we see some risks. And I think that this risk, particularly on the fiscal side, are signaled by the negative outlook. Really, at the end of the day, it will definitely depend on what the government actions are. I would just say that.
Perfect. Bernardo, same question to you.
I think I'm on the tudo mal spectrum, probably pretty much because I'm not a believer that the government changes that could trigger a reversal of this process are really in the pipeline for the next few years, at least for the next year.
Okay. Well, that concludes our Portuguese lesson for today. Thank you very much, Sebastian and Bernardo. Really, I thought that was terrific. I really, really enjoyed that. I hope the audience did as well. To the audience, you can follow us on Facebook, Twitter, LinkedIn as well. But that's all we have time for, and all the questions we have time for today. We remind you that you will receive the presentation slides in a follow-up email early next week. And look out for that email, as it will also contain webinar reply information, some related research, and follow-up video that addresses some of the questions we did not have time to answer during the sessions. So on behalf of S&P Capital IQ, I'd like to thank the panelists very much for their time. Thank you very much for your questions and attending. And we'll see you next time for the series, which we're doing a lot more of next year. So again, thank you very much.